Wirecard's collapse is causing global ripples.
The German finance minister said this was a failure of both the regulator and the auditor.
Wirecard shares, Vonnie, are once again sliding on another Financial Times report.
Auditors revealed that nearly $2 billion in cash has gone missing.
The former chief executive of Wirecard, Marcus Brown, has been arrested.
Wirecard.
Wirecard's origin isn't the kind of story they tell in business school. There was no garage, no eureka moment, no scrappy genius reinventing the industry. Instead, it begins on a flight in Germany from Munich to Berlin in 1997, when Paul Bohr sits next to a photographer from Hustler magazine. Yes, that Hustler. By the time the plane lands, Paul has a new obsession: the adult entertainment industry, specifically how to make money from it. At the time, the internet had unlocked an underground economy: online gambling, adult content, and other high-risk merchants that banks wanted nothing to do with. Customers were willing to pay, but chargebacks were too much of a nightmare. Sensing an opportunity, he launched InfoGenie, a bare-bones startup handling direct debit payments over dial-up internet. It wasn't much of a business, but by the year 2000, it had gone public. In reality, it was just a listed shell company with barely any operations. Its real asset was the stock ticker. Then luck strikes. A competitor handling online credit card transactions collapses. Or did it? You can be the judge. The competitor is Wirecard, a struggling Munich-based startup trying to make online payments work. Timing, however, is everything. And in 1999, Germany was in the middle of a tech gold rush. Wirecard rode that wave, branding itself as a digital-first disruptor. But when the bubble burst in early 2000, wiping out over $5 trillion in market value, Wirecard found itself in freefall, losing money, losing clients, and running out of time. Even worse, Wirecard's product wasn't special. Banks already handled online payments, and legitimate businesses had better, more reliable options. Wirecard had no product market fit, no brand recognition, and no reason to exist. Except it had one thing: an appetite for the business that banks would not touch. Gambling sites in particular constantly faced payment rejections, so Wirecard found ways around it by rerouting payments through intermediaries, tweaking transaction codes, and disguising transactions as restaurant bills or even travel expenses. Technically, it was fraud, but who was looking? And even if someone did, Wirecard always had an answer. Over the next 2 years, they doubled down on high-risk payments, but they were still barely surviving, very fragile, and one bad break away from disaster. That break came in early 2002, when Wirecard's entire system went dark. Transactions failed, clients panicked, and the company scrambled for answers. The culprit? A baffling technical meltdown traced back to one machine: Jan Marsalek's personal computer. Who is he? Only their lead developer. And somehow, every bit of Wirecard's internet traffic had been rerouted through his device, choking the system and throwing the business into chaos. A payments company entire system routed through one employee's personal computer? That wasn't a glitch. It was a glaring red flag. Payment processors have fail-safes to prevent this exact failure. Marsalek, who had a knack for exploiting loopholes, claimed it was a mistake. If true, it was catastrophic. If not, someone inside Wirecard had just tested how much control they really had. Of course, this weakened the company's position, and their loss was to be someone else's gain, because investor Florian Herzog from Infogenie swooped in with an offer shortly thereafter. Wirecard, however, refused. Then later that year, another very suspicious event rocked the company: a burglary at Wirecard's offices. Crucial financial records vanished, leaving the business in crisis. This time, Herzog didn't just offer. He acquired Wirecard for just €500,000, merging it with Infogenie. Wirecard, as the world would come to know it, was born. But again, was Infogenie just a struggling startup getting a lucky break? Or had someone quietly set the stage for something much bigger? It wouldn't be the first time that Paul Bauer saw an opening and took it. A few years earlier, he had pulled the same move with Camarades.com, an early live cam platform. Through his entity, Max Madhouse, he acquired a small stake, but his real goal wasn't investment. It was control. The day after the deal closed, he launched a minority shareholder lawsuit, trying to force the founders out. The plan failed, but it was only 2 years later that he would acquire Wirecard. Coincidence? Either way, Wirecard was now his. But a high-risk payments business with a shady past needed more than just customers. It needed credibility. So Paul Bauer makes his next move. To give Wirecard a veneer of legitimacy, he hires a consultant from KPMG, an Austrian named Markus Braun as CEO. He was serious, soft-spoken, and styled himself exactly like Steve Jobs, right down to the black turtleneck. And now, the stage was set, and almost immediately, Wirecard became a public company, but not in the way that most do. Normally, going public means putting your company under a microscope, filing a prospectus, facing investor scrutiny, answering tough questions. It's a whole risk assessment process. But Wirecard didn't do that. Instead, they pulled off a reverse takeover, slipping into the skin of a company that was already listed, Infogenie. So there were no roadshows, no regulatory deep dives, just a name swap. And suddenly, Wirecard was on the Frankfurt Stock Exchange. It was a clever move, but also a glaring red flag. Because when you skip the vetting, what exactly are you hiding? At first, it was just another small cap stock, barely registering on investors' radars. But in 2004, Markus Braun pushed Wirecard into the prime segment of the Frankfurt Stock Exchange, Germany's equivalent of moving from an over-the-counter listing to the Nasdaq or the New York Stock Exchange. It signaled legitimacy, attracting bigger investors and more scrutiny, but not enough to expose what was really happening behind the scenes. And it worked. But right after this major milestone, Paul Bauer, the founder, sold every single one of his shares in Wirecard. Gone. Just like that. You don't typically see founders bail out so fast, especially after a big public listing. But Wirecard was just getting started though. Revenue exploded over 975%, jumping from 4.6 million euros to 50.1 million euros in a single year. But with that growth came something far more concerning: complexity. A web of 10 subsidiaries and newly consolidated entities blurred the lines of what Wirecard actually was, making it harder for anyone to untangle where the money was truly coming from. But what did Wirecard do anyway? At its core, Wirecard was a payment processor, a middleman moving money from your bank to the merchant when you bought something. Now here's the basic flow. A customer swipes their card. The payment request goes to the customer's bank to check if the money is there. Wirecard, acting as the payment gateway, will code an encrypted message to quickly send to the acquiring bank or the merchant's bank, who receives the payment. The merchant gets their money and business is done. Now, Wirecard's role is just the gateway. They would move the data and take a small cut from the merchant. That's it. This is a simplified version of how payments work. Real life is messier. But what matters is this. Wirecard's role in the process was limited until they decided to change that. It's January 2006, and Wirecard is acquiring XCOM Bank, along with a crucial banking license. To top it off, Wirecard secured licenses from Visa and MasterCard, opening the door to global payment networks and brand new revenue streams. Suddenly, Wirecard wasn't just processing payments, it was controlling the whole transaction process, transforming from a middleman to a major financial player. Remember that before the deal, Wirecard made money from tiny transaction fees. After, they could earn interest on funds held and charge banking fees, which would push margins even higher. But here's where things get tricky. Wirecard wasn't a traditional institution like Chase or Bank of America. They didn't offer loans or savings accounts. Instead, they were a hybrid, part payment processor and part bank. It's what we know today as fintech. And that hybrid structure gave them wiggle room in financial reporting. They could present adjusted numbers that looked healthier than reality, making it harder for regulators and investors to truly understand the business. That year, Wirecard's income soared to 81.9 million euros, a 63% increase from the previous year. By 2008, Wirecard was showing no signs of slowing down. They rolled out virtual prepaid credit cards for online payments, doubling down on digital and riding the e-commerce boom. To the outside world, everything looked like it was falling into place. But behind the curtains, things weren't as good as they seemed. SDK, a small investor advocacy group dedicated to protecting retail shareholders, started raising concerns. They noticed inconsistencies and accused Wirecard of manipulating its balance sheet. How could a once so obscure payments company suddenly become a tech darling, expanding globally, minting profits, when no one could quite explain how? The investors believed they were onto something, but instead of investigating Wirecard, the German financial regulator, BaFin, turned its attention to the whistleblowers. Why? Because some of the members of the SDK were short sellers, investors who profit when a stock drops. And that was enough for BaFin to flip the narrative, accusing them of market manipulation, not the company they were questioning. The message was loud and clear. Don't bet against Wirecard. In response, Wirecard took decisive action. They commissioned a special report from Ernst & Young, EY, one of the world's most reputable auditing firms. With a touch of panache, Wirecard hoped the stamp of approval would silence their critics. To seal the deal, they also appointed EY as their official auditor, signaling to the market that the company was committed to transparency and integrity. But this move would later prove to be a double-edged sword, because EY's stamp of approval would buy Wirecard years of borrowed credibility and become one of the greatest failures in modern auditing. Fast forward a few years, and the SDK saga reached its boiling point. Two key figures were convicted of short selling and market manipulation. This crackdown on those trying to uncover the truth marked the beginning of a disturbing trend. Regulators seemed more focused on attacking the critics than addressing the company's issues. The SDK's credibility unraveled, and what began as a battle for transparency devolved into a self-interested tug-of-war where the lines between right and wrong blurred. Just as Wirecard's critics were being silenced, the company landed in a US money laundering scandal tied to $1.5 billion in illicit gambling proceeds, enough to tank its stock by 30% overnight. Now check this. In the year 2006, the US passed the Unlawful Internet Gambling Enforcement Act, banning financial institutions from processing online gambling payments. But Wirecard allegedly kept doing it, disguising transactions with false merchant codes to fly under the radar. Sounds familiar, right? Instead of owning up, Wirecard did what it did best and looked the other way. Wirecard's core business in Europe wasn't enough to make it a global player, especially now with the US market drying up. So it pivoted to markets with looser oversight, mostly Asia. And this is the most important shift in the story. Jan Marsalek, the same guy whose personal laptop once crashed the company's core system, had just been promoted to COO. Now, he was running the global expansion. They started with eCredit Plus in Singapore, a 12.8 million euro acquisition for a company with almost no revenue. But that didn't matter. What mattered was the footprint. Wirecard's new model relied on third-party acquirers, TPAs, local partners who processed transactions and gave Wirecard a cut. So say a customer spends $500 at an online shop. The local partner, the TPA, processes it, takes their cut of 5% or $25 and passes the rest along to the merchant. Wirecard's entire revenue would probably be $5 from this transaction, which is really a small portion of the TPA's fee for the transaction referral. But instead of reporting the $5 they actually earned, Wirecard claimed the full $500 transaction value as revenue. All of it, just straight up fiction. Wirecard inflated its revenue by reporting the entire transaction amount as revenue, even though they earned a tiny fraction of it. They were counting money they never saw. And if that wasn't enough, Wirecard kicked it up a notch with a technique that's just as audacious as it sounds: round tripping. It's a classic accounting trick where the same funds are cycled through different entities to appear as fresh revenue. For example, Company A in Singapore sends $5 million to Company B in Dubai. That money is forwarded to Company C in the Philippines, who might not even exist. Then, like magic, the same funds are routed back to Singapore, dressed as revenue. Wirecard ran this cycle on loop, rotating money through shell companies and TPAs to fabricate growth. And where did they say all that cash from the booming revenue was stored? In two obscure banks in the Philippines. But we'll come back to that later. The fraud hit a new level in 2014 when Wirecard acquired Hermes iTickets, an Indian payment processor. And this one, a total jaw-dropper. Wirecard paid a staggering 230 million euros, over 30 times what the company sold for just 6 weeks earlier. That kind of price jump should have triggered alarms everywhere, but no one blinked. Well, no one until later that year, when Dan McCrum from the Financial Times started poking holes into Wirecard's too good to be true numbers. He'd already seen enough inconsistencies to sense something was off, but the trail was still too hazy to make any clear conclusions. That's when he zeroed in on Ashazi, a company allegedly licensing Wirecard's payment processing software for 4 million euros a year. A trip to Bahrain was supposed to clear things up. Instead, it turned into a wild goose chase. Ashazi's office did not exist. Their corporate lawyer was nowhere to be found. After some asking around, Makram tracked down his office. Well, if you could call it that. It was tucked down an alley behind a fried chicken joint and looked like it hadn't seen a productive day of business in years, let alone house a multi-million euro operation. The deeper Makram dug, the more bizarre the narrative became. And so, in April 2015, he launched a blog series on the Financial Times called The House of Wirecard, raising critical questions about the company's operations. Things escalated quickly. Just months later, in February 2016, a report from Zatara Research and Investigations accused Wirecard of fraud, illegal gambling ties, and overpaying for businesses with shady connections. This wasn't just any report. No, this was a 100-page bombshell. The market reacted quickly, and shares dropped over 20%. Wirecard denied the allegations, but the damage was done. Even more, Zatara set a target price of €0 for the company's shares. But then, Germany's financial watchdog stepped in, but instead of scrutinizing Wirecard, they launched an investigation into market manipulation, pointing to a plethora of suspicious market participants. Wirecard, however, did not wait around for answers. Instead of defending itself with facts, it launched a full-scale PR and espionage operation. Phones were tapped, emails were hacked, and dissenters were followed. And even government officials weren't safe from surveillance. One of Wirecard's hired enforcers had a history of covert operations and arms deals. His past dealings even traced back to Gaddafi's Libyan regime. It was a kind of muscle that sent a clear message. Ask too many questions, and we'll make you the story. By February 2017, German business paper Mirage magazine uncovered troubling details about Wirecard's accounting, including €250 million in questionable receivables. But Finn's investigation stalled, and the company's stock continued to climb, more than doubling in value that year. Investors celebrated, while cracks in the foundation went largely unnoticed. In 2018, the Southern Investigative Reporting Foundation reignited the scandal, accusing Wirecard of foul play in its acquisition of Hermes. Once again, Buffin launched an investigation, and once again, they found nothing. Meanwhile, there was a whistleblower report from Wirecard's Singapore office about illegal money flows. It was swiftly suppressed by Marsalek, and despite all these damning issues, Wirecard's rise seemed unstoppable. By this, nearly half of its reported revenues were now coming from Asia, while its more established European operations struggled. By the end of 2018, its market cap had doubled from 12 billion to 24 billion euros, and Marcus Brown, who owned 8% of the company, was now a billionaire. To the untrained eye, everything seemed fine. Auditors gave the company a clean bill of health, and Wirecard joined the prestigious DAX 30, cementing its place among Germany's financial elite. Their stock hit new highs, peaking at €191 in September 2018, briefly putting Wirecard in the same league as financial giants like Deutsche Bank and Lufthansa. But there were still hints of doubt in the industry, and SoftBank helped Wirecard to clear the air. With a €900 million investment, while the turmoil was still swirling in the air, SoftBank wanted to show a vote of confidence and help them expand their Asia-Pacific business. As the year went on, more and more red flags popped up. It became clear that Wirecard's so-called revenue-driving Asian subsidiaries were basically empty shells. Some were operating out of bizarre locations, like a tour bus company in Manila. How do we know? The Financial Times investigation that had been ongoing since 2014 uncovered allegations of criminal activity in Wirecard's Singapore operations, triggering a dramatic 30% stock drop. Buffin defended Wirecard and even banned short selling, while the company sued journalists in an attempt to suppress the growing storm. Other reports revealed that Wirecard had been inflating its sales through subsidiaries in Dubai and Ireland. On top of that, the shady Hermes acquisition came back into focus. By this point, Wirecard's stock price was plummeting as the scale of the fraud became undeniable. With investor confidence rapidly eroding, Wirecard's board made the bold decision to bring in KPMG, an arch-rival of EY, to conduct a forensic audit. At this point, Wirecard had already made claims that it was holding 1.9 billion euros in escrow accounts in the Philippines. But when KPMG started its audit, they pointed out the uncomfortable truth. The 1.9 billion euros was nowhere to be found. But before we really dive into KPMG's findings, let's rewind to the 12 years when Wirecard's auditors, EY, were supposed to be keeping watch. Technically, EY did audit Wirecard, but let's call it what it was: a masterclass in doing the bare minimum. Sure, they ticked the boxes, but when it came to digging into real details that mattered, EY took a backseat and allowed a 24 billion euro fraud to unfold under their noses. First, let's talk about the 1.9 billion Wirecard claimed it had sitting in the Philippine banks. In any audit, it's basic procedure to verify a company's claims about its cash balance directly with the bank. But for 3 whole years, EY didn't make a single effort to confirm the 1.9 billion euros with the banks themselves. Instead, they accepted Wirecard's forged confirmations. 3 years without verifying the cash? How's that for oversight? They were handed photoshopped documents showing cash reserves and other critical details, and they didn't bother verifying them with the actual banks. Because reviewing fake PDFs could pass for due diligence, right? Wirecard also claimed a significant portion of its revenue came from third-party agents in far-flung places like Dubai and the Philippines. Did EY investigate these relationships? Not really. EY's audit strategy boiled down to don't ask, don't verify. For a company claiming billions in overseas revenue, they didn't bother cross-checking a single third-party ledger or even verifying customer existence. It wasn't an audit, it was a rubber stamp. By 2020, the truth about Wirecard's massive fraud finally came to light, and it was every bit as bad as people had feared. KPMG's special audit couldn't verify most of Wirecard's reported profits from 2016-2018, which pretty much blew the lid off the company's entire operation. But in a bizarre twist, Wirecard would try to downplay the findings, insisting that KPMG's report didn't prove anything about balance sheet fraud. But the market wasn't convinced. The very next day, Wirecard stock tanked by 25%. And right after, we had some very convenient timing. EY finally decided to check the actual bank statements after all these years. Then on June 18th, 2020, the company announced a delay in its 2019 annual report, citing spurious balance confirmations about the missing 1.9 billion euros cash. Within minutes, the stock collapsed, down 60% in a single day. Billions in market value vanished before lunchtime. The message? Investors were done playing make-believe. Things continued to spiral, and on June 19th, CEO Marcus Brown stepped down. But that didn't stop the disaster. Just 2 days later, the Philippine Central Bank confirmed what many had suspected. The missing funds never made it into the country's financial system. Wirecard's claims were officially exposed as lies. On June 22nd, Wirecard admitted it was likely the $1.9 billion didn't exist at all. Brown was arrested that same day, and by evening, the stock had nosedived below 15 euros. 3 days later, Wirecard filed for insolvency. The stock hit a new low of 3.50 euros. And let's just say, things kept getting worse. By August 28, it dipped under €1, leaving some to wonder if that Zatara report from years ago, which predicted the company's worth would be €0, was more fortune teller than financial analysis. The German stock exchange now had to face reality. After Wirecard filed for insolvency, the company's stock was officially delisted. The delisting was the final blow, an official recognition that Wirecard had been nothing more than smoke and mirrors all along. As for Brown, well, the man who'd once been crowned a visionary leader was now at the center of one of the largest corporate frauds in history. His defense team tried to paint him as a poor victim of some grand conspiracy, but the evidence stacked higher than a skyscraper of bad decisions. By 2021, Brown was facing serious charges: fraud, market manipulation, embezzlement, and the case kept unraveling like a cheap sweater. By 2024, he was ordered to pay €140 million in damages. And on top of that, Wirecard investors were filing lawsuits to the tune of €750 million. The final verdict? Well, that's to be determined later this year. Thought the story was done? Nope. Because there's the Houdini of corporate crime, Jan Marsalek. His disappearance became one of the most enigmatic aspects of the Wirecard scandal. When Brown was arrested, Marsalek, Wirecard's COO and potential mastermind, disappeared. Was he a corporate kingpin orchestrating the whole scheme, or just another guy who got caught too deep into the web and decided to bail before the spider noticed? As Austrian authorities scrambled to catch up, Marsalek remained a ghost. Despite a high-profile international arrest warrant, the man was more elusive than a Wi-Fi signal in a basement. Theories began flying. Was he hiding out in Moscow, sipping vodka on a yacht, protected by Russian officials? After all, he did have a very close connection with them. So maybe not. But one thing's for sure, his disappearance became just as mysterious as Wirecard's entire downfall. It's a mystery that still looms large, leaving us wondering if we'll ever get the full story, or if Marsalek will remain the ultimate ghost in Wirecard's haunted house of fraud. And so, as Wirecard's demise continues to echo through time, Marsalek's vanishing act remains the cherry on top of one of the most dramatic scandals in modern business history. Will we ever see him brought to justice? Or is he, like the billions that disappeared, just another piece of the puzzle that may never quite fit? Guess we'll have to wait and see. But something tells me we haven't heard the last of this twisted tale just yet. If you made it this far, you're exactly who I make these breakdowns for. So like the video, drop a comment, and subscribe. Hit the bell so you don't miss the next collapse, cover-up, or corporate train wreck. Thanks for watching.